हेलो बच्चा लोग, कैसे चल रही है एग्जाम्स की तैयारी और पढ़ाई कैसे चल रहा है? आई होप इट्स गोइंग रियली वेल. So let's start today's explainer with a fresh new chapter, the LLP. We're gonna take this nice and slow today, okay? That way every single concept just locks right into your memory for those ICAI exams. Welcome back to CA Made Easy.
All right, here is our anime training arc agenda for today. Number 1, welcome to Chapter 5. 2, the ultimate hybrid concept. 3, key features of LLPs. 4, LLP versus traditional partnership. And 5, incorporation and designated partners. Artamain na Pilalu, let's get completely focused.
Section 1. Welcome to Chapter 5, looking at the framework of the LLP Act 2008. And just keep in mind those crucial dates, December 12th, 2008 and January 7th, 2009. Now, you might be wondering who actually runs the show when it comes to LLPs. Listen up, because this gets heavily tested. The LLP Act is strictly administered by the Ministry of Corporate Affairs, that's the MCA, and the Registrar of Companies, the ROC. The central government holds the absolute authority to frame the rules for this act, and they can amend them right through the official gazette. So MCA and ROC, lock those names in your head right now. Moving on to Section 2, the ultimate hybrid concept. Basically, the fusion technique of business law. So if you watch anime, you definitely know about the fusion technique, right? You know, where two powerful warriors combine into one ultimate being? Well, that is exactly what the LLP is in the world of business law. It is literally the ultimate hybrid. See, an LLP fuses the limited liability shield of a corporate company with the flexible internal structure and low compliance cost of a traditional partnership. You get the safety net of a company, which means your personal assets are fully protected, but at the same time, you get the freedom to run the internal management just like a classic partnership firm. It's an absolute win-win, the best of both worlds.
Okay, I need you to memorize this specific stat for your MCQs. Ready? The LLP Act contains exactly 81 sections. Just 81. It's a very crisp, super efficient piece of legislation, especially when you compare it to the massive Companies Act.
Perinjida? Good. Now let's follow that up with the second crucial stat. The Act has exactly 4 schedules. Yep, 81 sections, 4 schedules. Whatever you do not mix these numbers up in the exam hall. Actually, do me a favor and take a screenshot of this right now. The ICAI absolutely loves testing the contents of these 4 specific schedules. So the first schedule deals with the mutual rights and duties of partners when there's no formal agreement in place. The second schedule is all about converting an existing firm into an LLP. The third schedule covers converting a private company into an LLP. And the fourth schedule, that's for converting an unlisted public company into an LLP. Make sure you memorize that exact order.
All right, Section 3, Key Features of LLPs. Let's understand the core stats of this entity.
Got it, eh? Excellent. Let's dissect these base stats to really understand how this entity operates in the real world. We'll start with perpetual succession. Because an LLP is a separate legal entity, it basically lives forever, or at least until it's legally dissolved. Partners might join, they might leave, they can retire, or even unfortunately pass away. But the LLP, it continues its existence completely uninterrupted. It can hold property, it can enter into contracts, all under its own name.
Now, here's a really crucial point: mutual agency. In a standard partnership, one partner's mistake can literally ruin everyone else, but not in an LLP. In an LLP, every partner is an agent of the LLP itself, but they are absolutely not agents of the other partners. What does that mean for you? Well, your actions bind the firm, sure, but they do not legally trap your fellow partners. Your liability is strictly limited to your agreed contribution. That's a huge relief, right? Okay, time for a high-value exam hack, so pay close attention. The financial year for an LLP is generally April 1st to March 31st. But, and this is a big but, if the LLP is incorporated after September 30th, the financial year ends on March 31st of the next following year. So let's say you incorporate on October 1st, 2023. Your first financial year doesn't end until March 31st, 2025. Please don't let them trick you on this in the exam. Let's move to Section 4, LLP versus traditional partnership, the ultimate sparring match.
We're going to pit the LLP directly against the traditional firm right now to see the actual differences. Let's walk through these slowly. First off, registration for an LLP is absolutely mandatory, whereas for a partnership, it's just voluntary.
An LLP is created by a strict legal process under the Act, while a regular firm is just created by a simple agreement. Now for the biggest one. Liability in an LLP is limited to your contribution, except, of course, in cases of willful fraud. In a traditional partnership, liability is unlimited and can completely drain your personal assets. Finally, an LLP must have the letters LLP as a suffix in its name, while standard firms have no such strict guidelines.
And finally, Section 5, Incorporation and Designated Partners. Time to master the technique.
This is where the theory turns into real-world practice. How do you actually summon and register an LLP? Well, first you need 2 or more persons associating for a lawful business with a view to profit. Keep in mind, if you're doing charity work, you cannot form an LLP. Second, those folks must subscribe their names to an incorporation document. Third, you file that document with the registrar of the state where the registered office will be situated and pay the required fees. And finally, just file a prescribed statement along with it. Pretty straightforward.
Now, let's break down Section 7. These are the rules for designated partners. And listen, this is prime territory for descriptive exam questions. Every single LLP must have at least 2 designated partners, and they must be individuals. That means a company cannot be a designated partner. Furthermore, at least one of them must be a resident in India. Now, if your LLP consists entirely of body corporates, what happens then? Well, the individuals nominated by those corporate bodies will step up and act as the designated partners.
All right. I want to share one last critical hack with you before we finish up today. It's the 6-month liability rule. If the number of partners in an LLP falls below the legal minimum of 2, and the sole remaining partner carries on business for more than 6 months, well, that sole partner becomes personally liable for all obligations incurred after those 6 months, provided they knew they were operating alone. Basically, the limited liability shield completely drops. Manos alayo? Up to 6 months, the LLP is liable. But after 6 months, the individual takes the hit.
So, I'll leave you with this question to think about. Considering that amazing protective shield of a company combined with the low-cost flexibility of a partnership, is the LLP the ultimate legal structure for modern Indian businesses? It certainly revolutionized business law back in 2008. Keep reviewing the info in this explainer, make sure you remember those key sections, and you absolutely crush this chapter. Wishing you immense success on your ICI exams, keep studying hard. But chalo.